to this special, the budget fine print. As widely expected, Finance Minister Piyush Goyal announced a slew of measures for the common taxpayer in the Modi government's last budget before the 2019 elections. While there is tax relief for those earning up to 5 lakh rupees, homeowners also have something to cheer about. So what does Budget 2019 mean for your finances, your investments and your wealth plan? Joining me to decode the impact are Kalpen Parikh, President of DSP Investment Managers, Ashish Shanker, Head of Investment Advisory at Motilal Oswal, and Gautam Mehra, Tax and Regulatory Leader at PwC India. Gentlemen, thank you very much for joining in. The big day is behind us. There are several points that we need to go over, but before we get to that action, let's actually hear out the Finance Minister announce the relief on income tax.
I propose the following changes. Individual taxpayers having taxable annual income up to rupees 5 lakhs will get full tax rebate and therefore will not be required to pay any tax. As a result, even persons having gross income up to rupees 6.5 lakhs may not be required to pay any income tax.
Well, that was a finance minister in parliament earlier. Gautam, that was a smart play on words, right? Because for a moment, I think we were all wondering that whether this is a change in the tax slab, so basically no tax till 5 lakh rupees. That's not the case, correct?
Yeah, that's right. So what has happened is that for a taxpayer who is getting income, taxable income up to 5 lakhs, that taxpayer is paying tax today. But the proposal is for that taxpayer, there will be no tax payable for the next year. And the way this works is there is this is a rebate, not an exemption. So the 5 lakh slab remains as it is. This year, if you have income of 5 lakhs, you have a tax liability of 12,500. You pay that and that's it. Next year, same situation, you have income of 5 lakhs, you have an on paper tax liability of 12,500, you get a rebate of 12,500 and therefore the net tax payable is 0.
So,
but
till last year, you were earning 5 lakhs, but you weren't enjoying the rebate because the rebate was capped at 3.5 lakhs of income. Now, no tax liability, should we safely say, for those who are earning up to 5 lakhs?
That's right.
Okay, but the good news pretty much ends there. Absolutely no follow through for anybody who is earning even 5 lakh 1 rupee.
Yeah, so for 5 lakh 1 rupee, this benefit doesn't extend. But technically, you could be earning more than 5 lakh. So if you're earning a salary income of 5 lakh 50 without any investments, they've increased the standard deduction from 40 to 50. So 5 lakh 50 total income, 50,000 standard deduction, you come to 5 lakhs. You add something more, 7 lakhs income, 1.5 lakhs investment deduction, 50,000 standard deduction, you come to 5 lakhs. So the magic here is get your taxable income to below 5 lakhs and you earn this.
I don't see how that's really possible unless you have some extremely sort of creative, sort of accounting or, tax management that you can employ. But really, let's get in thoughts from the other guests as well and take a step back. Apart from this income tax announcement, Kalpen, your first thoughts on sort of what was announced? Do you call this a populist budget? Do you call it a popular budget? How do you rate it?
I think time will tell whether it's populist or popular, because on the day of budget there is a lot of hyperactivity to try and label it, but in a way it's futile. It doesn't matter over a period of time. What I think I picked up a couple of things from the budget is it was very sharp-shooted and targeted at segments. So the segmentation was apt, which is catering to the needs of the farmers and the salaried employees. And one interesting point that I picked up is, anyways, almost 90% of taxpayers come within this 5 lakh pool. So in a way it increases the efficiency of tax collection, because this segment may not have material impact in terms of resources of the government to create finances by giving this benefit or advantage. So you are in a way eliminating a lot of tax hassles for a large part of the population which is paying tax today. But that apart, I think over time we'll realize the impact of these actions, because things don't change overnight. And I think I also recognize the fact that being an interim budget, the government doesn't have the ability to do much. What is good is it's not disruptive and it's sensible in terms of the overall finances. So it's responsible in that context, and hopefully it will keep markets steady.
Okay, fair enough. Ashish, your assessment?
Yeah, so I think it was a very smart budget because they've tried to cater to as many people as possible because going into an election, you want many people on your side. So over the last 4 or 5 years, they've done a lot for the corporate taxation. So they brought the corporate taxation to 25% for companies with a turnover of less than 250 crores. So I think this was the time to give the individual taxpayers also some relief. So that is what they did with this exemption for taxpayers up to 5 lakhs. Other than that, there was a lot of announcements for the farm sector. And I think they chose the direct benefit transfer route as opposed to some of the other arguments which were being made before the budget. So I think it was a very smart budget. There was a very limited room for the finance minister to play with, because on one side he had to stick to fiscal prudence, because otherwise that would upset the international investors and the rating agencies. But at the same time he had to come up with enough tricks to ensure that the voter population is pleased with the budget. So I think he's done exactly that. So I would call it a very, very smart budget.
Okay, Gautam, your thoughts on this? Ashish alluded to the 25% taxation for companies with turnover of 250 crores or less. Given that this is a transition phase, we're looking at polls, we're also looking at the direct access code eventually becoming a reality. Is that why perhaps it was futile to expect anything more than this, or were you expecting bigger announcements or more precise announcements on direct tax?
No, I think expectations going into the budget were very muted, especially on the tax front. One was expecting policy announcements which have come out, but at least as far as amendments to the Income Tax Act, just historically and parliamentary knobs, nobody touches the Income Tax Act too much in this budget. So expectations were at that level, and this was pretty much aligned with those expectations. I think the other part is that there's a 1 lakh crore of shortfall in the indirect tax revenue collections. And that was the other worry, that how will the revised revenue collections look this year? But the government seems to have at least budgeted that they will make up half of that from corporate tax collections, and the rest of the half is coming from a couple of other things. So if we had hit GST collections, I think the government would have had a lot more space to do more. This relief of 25% tax rate to only a certain segment of companies, one hopes that this goes up and we've got more room later on.
Absolutely. Kalvin, you were telling us earlier in the break that you've done some numbers on it. The cost of giving this relief to those who are earning up to 5 lakhs, I mean, whether that will really sort of throw the math awry or not, because as Gautam is also saying, there's a GST shortfall that one has to contend with. There is this farm income package that's been announced. They've budgeted 75,000 crores for next year. So does the fiscal deficit number from the market standpoint look credible?
Yeah, so I think what they've given for the salaried class is still not a very big number from impact on fiscal. The larger number is the farm loan waiver, so to say, and that is a larger number, and the bond market is indicating that they'll have to wait and watch what is the implication, because yields have sold off by 20 basis points since the beginning of the budget announcement. So I think directionally yields had come down in the last couple of quarters, a couple of months, and the market was waiting for the budget to see that are they able to stick to broad fiscal maths. There is a 1 lakh crore extra likelihood of deficit and extra borrowing that could come through, and immediately they've announced that we will need to borrow 40,000 crores more than budgeted. So the reaction of the bond market is of a little bit of worry in context to that. So the supply of bonds goes up by 40,000 crores, which is the reason why markets have sold off.
Okay, well, we will be talking more about investments in the market in just a bit, but right now let's bring it back down to nuts and bolts and brass tacks. Of course, there will be the usual disappointments. ATC, we thought if this is 1 year there, when we'll see the limit go up, it might be this because it's pre-election. That's not happened, Gautam. And also the fact that medical deduction, for instance, those small heads that we had here and there, where there was hope that maybe there'll be an increase, none of that coming through.
Well, we still have the, final budget to come through. So there will probably be scope in that to make these kind of changes. As I mentioned, going in expectations for this budget is don't touch the Income Tax Act, and there have been only amendments to 8 sections of the whole budget in this interim budget. If you look at the normal list, it's about 60-70 at least amendments coming through every budget. So they've been very, very curtailed and constrained on what they're doing now.
So it is really interim in nature. They've stuck to the plan, at least as far as that goes. Ashish, from a wealth point of view, given that there's just small tinkering on the tax front up till 5 lakhs, in terms of more money in the hands of people, does anything really change?
So I don't think it changes that much. I think we are relieved that there is no major tinkering in capital gains taxation, because last year, with the introduction of the long-term capital gains, there was a lot of flutter caused in the capital market segment. So we're just happy that he's not touched any of that. So whether it's STT, whether it's short-term taxation, whether it's long-term capital gains, and frankly, like Gautam said, the expectations were also muted. So the expectations were that he should not change much, and so I think markets will take it in their stride.
On the stamp duty front, Gautam, I don't know if you picked this up or not. He did sort of allude to it, that stamp duty will be applicable, I think, even on demat shares, and it will be collected through the stock exchange. If you could just explain that to us.
Yeah, we've yet to read the fine print, but I think that is a very positive development, because it's more about rationalization of the way stamp duty is charged and collected today. So they are talking of centralizing that and just doing it through one agency, and then giving the shares the due stuff, because right now it's quite spread out across the country. So that's a positive move.
Kalpani, any thoughts on this, just from a industry standpoint, stamp duty and the way stock transactions might?
I have not really gone into that.
Okay, all right. Okay, fair enough, gentlemen. We'll take a quick break on that note, but the conversation continues on the other side. We will discuss the impact this budget has on housing. There are several announcements coming in, some relief if you have a second home. Also, we will ask the panel if anything really changes for your investment and your wealth in fiscal year 2020. Welcome back to our special budget coverage. We are decoding the budget fine print with respect to your investments and the personal finance framework. So, gentlemen, as I think all of you seem to be in agreement that there's no major disruption. That's the good thing about this budget. Let me now specifically come to some of the provisions which are relating with housing. So first, help us understand this, Gautam. What one gets to understand is that now, first of all, if you have a second home, the notional rental income from that home is not going to be taxed. Is that how it should be read, or is there a catch even there?
No catch over there. Cricket is over. So, yeah, you're absolutely right. Firstly, before I come to answer the question, I think this whole piece of notional rent itself, if you go back to first principles, you're taxing something which you're not really, getting in cash. Getting in cash. Yes. It's a kind of a negative for holding on to a vacant property, right? And this is in a way a penal tax for that.
Yeah.
So today the law says that if you have more than what is called one self-occupied property, so the house that you stay in, you don't pay any notional tax on that. But any other apartment that is vacant, you're not earning rent on that, you will have a notional tax which is calculated on a certain basis having regard to the municipal value, the rent that it would earn, etc. So they have exempted a second property from this notional tax.
Okay.
So
and no fine print, no conditions. This is just clear. So if you do have a second home, whether it's vacant, whether it's occupied by, let's say, family, so there's no,
So you should not be earning any rent on that, right? So long as that's the case, you will get the exemption from any notional tax on that.
Okay. With respect to property, another change, and help us understand this as well. When you're going to be selling a property, earlier I think you could basically set off the entire capital gains by reinvesting it in another house. Now there is a provision where you can actually split this amount in two different houses. How does it work?
That's right. So the original section stays as it is.
Okay.
One house to one house, you get a complete rollover irrespective of the amount of capital gains. What they have given a relief for is that instead of investing in one house, if you want to invest in two houses, that is permitted. There's only catch in that is that
there's always a catch. If there's tax, there has to be a catch.
Well, I'll say it's more a targeted and focused exemption given, where the amount of capital gains does not exceed 2 crores.
Okay.
And that's a pretty significant number. I mean, just exclude Bombay for a moment, but most of the other cities and across tier 2 cities, definitely, almost everybody should be able to get this exemption.
Absolutely.
So it's targeted that you can avail of this 2-house piece, but for capital gains up to 2 crores.
So a lot more flexibility being given with respect to sort of buying and selling immovable property. Ashish, your thoughts on this? Some of these housing provisions, do they sort of change the needle at all, move the needle at all with respect to how attractive or rather unattractive this sector has become for investors?
So if you look at this sector over the last 3-4 years, a barrage of volleys have been fired at this sector. You had demonetization, You had the RERA regulation coming into effect. So really this sector has been on the back foot, and you could see that in the volumes, as well as you could see that in distress in terms of the developers. So this budget is an effort to start reviving the sector again, because remember, other than the infra and capital goods sector, this is one sector which can contribute majorly to employment and revive spending in the investment areas. So I think a lot of the relief which is given will stem the fall in this sector. Whether investors come back and participate in the big way is to be seen. But what they've really done is they've tried to give a lot of benefit to mid-income and affordable housing.
To actual homeowners.
So, yes,
really,
actual homeowners. So it's very, very targeted. So things like, you can now own a second home, without worrying about
the tax liability.
The tax liability. Similarly, developers who have constructed and got the OC can now hold inventory for 2 years instead of holding it for 1 year and then worrying about taxation on the inventory that they are holding. Similarly, I think in the affordable segment, they have increased the tax holiday by 1 more year, if I'm not mistaken. So that should also see some investment activity.
I think that would be the section that applies to houses of a certain ticket size. I think 30 lakhs was the
30 square meters and 60
30
square meters.
Okay. So basically that gets extended.
Yeah. So earlier the existing law says that the housing project has to be approved by March 19 to get the exemption. They've extended that approval by a year. So you can get your project approved by March 2020 and yet be entitled to the tax exemption.
And ticket value cap?
It's 30 square meters and 60 square meters.
Okay, so it's an area cap.
It's an area.
Okay.
There are some other conditions, but primarily the size of the flat is this is the condition.
Okay, so some more flexibility, some more leeway for housing. Kalpen, which brings me to you. I mean, over the last, I think, year or basically 2 years, there's just been a one-way flow. It's all about financial products. It's all about mutual funds. Do you at all see the needle turning a little away from mutual funds, maybe to some of these other classical assets?
See, if you notice, in the last couple of months, the one-way flow has slowed down a bit.
Yes, quite a bit at that.
Generally, flows follow prices. So when prices go up, flows chase them and create a virtuous cycle. But we are seeing a slowdown or a bit of stagnation of flows.
That hasn't broken, right? That correlation, despite all the wealth advice that's given out, all the education that's given out, that buy when prices are falling and sell when prices are over the top, doesn't seem to be really
so true. It's
home.
A universal reality, and maybe we are not doing a good job to change that. But I think the reality is, see, the last 5 years, markets have been driven more by valuation expanding than earnings. I say that our earnings have not come out of earnings; they've come more out of PE expansion. And it's been a long time that market has been waiting that earnings cycle will revive and the momentum will come back. But that's been taking its own time, and that I think continues. So there is a bit of restlessness that investors have, and I think the only way to solve for this is to change the conversations to more structural long-term investing and fundamentals versus tracking short-term data points or events. But that's not the way the investment world or the markets operate. So the whole ecosystem has a very near-term approach of looking at investing. So if you were to tell someone that invest for 10 years and forget everything, and don't worry about what's going to happen, don't worry about the 10 budgets and the 2 elections and stuff like that, it's not how the real world operates. And in that context, flows have slowed down, keeping in mind that there are a couple of events, budget is there, next year election will be there. So there is enough empirical evidence that these things in the medium to long term almost do not matter.
Speaking of long term, this was a conversation we were having pre-budget as well, on a similar panel, whether the concept of long term, whether enough justice has been done to it, because the tax kicks in after 1 year instead of, let's say, 3 years, which is the case with debt mutual funds. I mean, it's a little pointless discussing it now because the interim budget is over, but we will get to the actual budget come July. Your thoughts on the way long-term capital gains tax is played out for the industry, Kalpen?
So while there is a correlation that long-term gains came in around a year back, year back, and then markets since then have not done well. But I would not say that markets didn't do well because of long-term gains. There are inherent reasons, and the nature of bond markets or equity markets is volatility. Sometimes we use events to justify that. Of course, if taxes are removed, I'm not saying that if we make taxes zero, lot more money will start coming in, because even today, the 10% tax slab is still the most efficient tax slab. So, or equity, after a year getting taxed at 10% is the most efficient asset class. So I have a view that it is not taxation.
It's not taxes which is
deterring the investor to invest.
Absolutely.
It is the anxiety that always prevails at higher prices.
Now, having said this, let me come to dividends, because that was a huge bugbear with the industry. Both had, dividends at the company level when they're being paid out.
Multiple rounds of taxation.
And the DDD that started getting levied on investors, the end investor.
End investors.
And that seems to have killed the balance fund category completely. What should we expect in the months ahead?
So again, the balance fund category is nothing but a quasi-equity category, because 70% of the investments are in equity. So the balance fund NAVs will also move 70% like equity. So when markets fall 10 or let's say 15%, balance funds will fall 10%. The money which came in because of the so-called stability of dividends came in assuming this is like a fixed return product, and when volatility came, most investors were unprepared. So I think there the industry needs to be far more responsible and not position that as a monthly return product and more as a 5-year product with an asset allocation framework. I think that will do a lot of justice. It's one of the best product category the industry could have created. Yeah,
dwindling flows. I mean, hardly any flows coming in over the last several months. Okay, gentlemen, since we're coming down to last thoughts, let's do this. So, Gautam, this is interim. When we get to the actual, come July, once we have a government in place, then what should be the wish list? I know I'm jumping the gun here, but there's a lot of unfinished business. For instance, DTC, for instance, the way dividends are getting taxed, etc. So, what do you think is top of the mind with respect to taxation as we get into the post-election season?
So, just picking up the point I just made, you look at taxation of just income from capital markets. We have rates 0, 10, 15, 20, 30, 40, depending on how you're investing, depending on who's investing, and depending on the period of holding. So mutual funds, AIF, PMS, direct, everything gets taxed differently. So clearly a need to just simplify this whole thing, don't have any arbitrage between different intermediaries of getting into capital markets. So that's one big simplification exercise which is there. I think a few more things which have been around for quite some time, and just talking from the capital markets perspective, a bit of stuff around the category 3 AIFs, the whole and this gets linked to this, or for that matter Make in India on the service sector. The whole asset management industry has been looking at the Section 9A and being able to manage offshore money from India, very much aligned with the government's motive and intent. So these are, I would say, low-hanging fruit. Of course, I don't think we will have enough time for the DTC, because in all fairness that needs to be put out in public domain and a discussion before it becomes law. So maybe the June or whenever this budget comes out, be good time to throw it out for discussion, but implement it from next year.
Okay, fair enough. Ashish, final thoughts with you as well. I mean, from a wealth management perspective, how do you sort of sum up this budget and of course the next couple of months?
So from a investment point of view, I guess our thoughts pre-budget, post-budget are unchanged. If you look at the bond markets, they are clearly a little worried about the budget maths, and they're worried about the fact that fiscal deficit number is not going down to 3.1 as promised. It's staying at 3.4. So yields have moved up. But our advice is still to clients is that buy bond funds which are in the 2 to 3 year maturity range, buy high quality bond funds, keep the maturity low, and the real rates are still very, very attractive if you look at the inflation and if you look at what yields markets are giving you. On the equity side, our advice was to gradually accumulate till the elections. I think that is again unchanged. However, one expectation over the last couple of years that markets have had is that the investment cycle will revive. I think that gets pushed back further, because if you look at all the giveaways in the budget, it leaves very little for the government to spur or give money to the investment sector. So you are basically depending on the private sector to do capex, which is then dependent on capacity utilization, which takes its own time. So again, equities look attractive, but for the larger market to revive and the economy to do well, you need the investment sector pulling its weight. So that's what my
all right, I think there's plenty to think about as we get into election season and then get an actual budget come the next government. Thank you, gentlemen, very much for sparing time and sharing thoughts on what we have seen in interim budget 2019. That's it from this panel on this special. Thank you for watching.